So guys, gold over $5,000 and silver over $100. Over the past few sessions, markets have shifted into a noticeably more cautious regime. We've seen volatility pick up across FX, equities, and commodities as traders digest a mix of macro uncertainty and geopolitical risk, as well as policy noise. Now, tariff headlines, central bank expectations, and safe haven flows have been the dominant drivers, with the US dollar, gold, and yen all reacting sharply. But at the same time, equities have struggled to build momentum, while crude oil remains highly sensitive to geopolitical developments. And in this update, I want to focus on three key areas: the US dollar and FX, the equities and indices markets, and metals, with crude oil as an important cross-market signal and what they're telling us about risk going forward into this week. So starting with FX, the US dollar has been the main transmission mechanism for risk sentiment. Here, looking at Euro US dollar, we can see that we rallied all through last week into this area of supply. We're currently reacting and we're pulling back on the day at the moment. This is Monday the 26th of January. Where the dollar goes from here is a little bit uncertain. Now, after a period of weakness, the dollar has stabilized as markets reassess growth and rate expectations. But the key takeaway here is that FX markets are no longer pricing in a clean risk-on environment. Instead, we're seeing selective dollar strength and safe haven demand. So what does this mean for traders? Well, this means FX volatility is likely to stay elevated, especially around the data releases and central bank guidance. Euro dollar being at the highs, looking uncertain, doesn't give traders a very clear signal for the moment as to where we might go. The trend is clearly bullish, but that technical level in the way of price going any higher is currently at play. Now, if we move to the equities and indices markets, the US markets have struggled to sustain upside momentum. Here, if we look at the US 500, you can see that it's been pretty range bound. There hasn't been a major sell-off, but rallies have been shallow and quickly faded. This tells us that the risk appetite is fragile rather than bullish. This market is actually providing a lot of opportunity. If you look at the lower time frames, you can see that these range-bound markets react to supply and demand continuously. And this kind of price action usually appears when markets are waiting for a macro catalyst, whether that's a central bank policy, earnings guidance, or the geopolitical clarity we're seeking. Now, from a trading perspective, indices are behaving more like a late cycle market. The dips are easily bought, but conviction is low and the upside is capped. So taking that quick risk reward, getting in and out of these markets relatively quickly, is advised. Now, there's not much technically to say about gold, but metals have been one of the clearest signals in the market over the last 6 months. Gold has continued to attract inflows, reflecting both geopolitical uncertainty and declining confidence in risk assets. When gold rises alongside a stable or stronger dollar, it usually signals deeper underlying stress, not just inflation hedging. There is absolutely nothing to the left to reference as a point of sale. So for us at the moment, it's just a case of buying dips at key areas of demand. Having said that, the last 5 candles on the daily time frame, massively bullish. So we're not seeing any clear signal for a current buy until we see some form of pullback. So what about the week ahead? Well, the key theme for this week is where the markets transition from uncertainty into a clearer risk regime. Now, traders should be watching 3 things very closely this week. 1, the trend in the US dollar. 2, the structure of equity indices. And 3, the behavior of gold and crude oil. If the dollar strengthens while gold continues to attract demand, that would confirm a deeper risk-off move developing beneath the surface of the market. But on the other hand, if equities stabilize and the dollar weakens, we could see risk assets attempt another leg higher, though conviction would still need to be confirmed. Now, a major focal point this week is the Federal Reserve's rate decision on Wednesday evening. Not so much for the rate itself, but for the tone of the statement and forward guidance after the rate decision. Markets will be watching closely for any shift in how the Fed frames inflation, growth, and financial conditions. For now, this is a market that rewards patience and macro awareness rather than aggressive positioning. The next decisive move is likely to come from policy, data, or geopolitics, not the technicals alone on the chart.